The stock market can seem like a daunting labyrinth, a whirlwind of numbers, charts, and jargon. But beneath the surface lies a fascinating world of opportunity, a place where companies raise capital and individuals can grow their wealth. This journey, from novice investor to seasoned trader, begins with a single step: understanding the basics. This essay will serve as your guide, demystifying the complexities of the stock market and equipping you with the knowledge to navigate its twists and turns. Imagine owning a tiny piece of a giant corporation, a stake in its successes and failures. That's what owning stock means. You become a shareholder, a part owner in companies like Reliance Industries, HDFC Bank, or Infosys. As these companies flourish, so does the value of your investment. But the stock market is not a guaranteed path to riches. It's a dynamic ecosystem driven by a multitude of factors, from global economic trends to company-specific news. Understanding these factors and how they influence stock prices is crucial for making informed investment decisions. This is where we begin our journey, equipping you with the knowledge and skills to confidently navigate the exciting world of stock market investing. At its core, the stock market is a marketplace where buyers and sellers converge to trade shares of publicly listed companies. Think of it as a giant auction house, but instead of paintings or antiques, you're trading ownership in businesses. Let's take the example of two prominent players in the Indian stock market, Hindustan Unilever and Tata Consultancy Services, or TCS. Hindustan Unilever, a consumer goods giant, is behind iconic brands like Dove, Surf Excel, and Lipton. TCS, on the other hand, is a global IT services and consulting behemoth, partnering with businesses worldwide to drive digital transformation. When you buy shares of Hindustan Unilever, you're essentially buying a small piece of the company that produces your favorite soap or tea. Similarly, owning TCS stock gives you a stake in a company at the forefront of technological innovation. But how are these shares valued? The answer lies in the forces of supply and demand. When more investors are bullish about a company's future prospects, the demand for its shares rises, pushing the price upwards. Conversely, negative news or a bleak economic outlook can lead to selling pressure, driving the price down. Understanding this interplay of supply and demand is fundamental to grasping how the stock market operates. But it's just the tip of the iceberg. Factors like company performance, industry trends, government policies, and global events all play a role in shaping stock prices. To make sense of the vast Indian stock market, indices like the Nifty 50 come into play. Think of the Nifty 50 as a carefully curated basket of the top 50 companies listed on the National Stock Exchange of India. It represents a snapshot of the Indian stock market's overall health and performance. These 50 companies, spanning diverse sectors like finance, IT, energy, and consumer goods, are carefully selected based on market capitalization, liquidity, and trading activity. The Nifty 50's performance is often considered a barometer for the Indian economy as a whole. When you hear on the news that the Nifty is up by 100 points, it means the combined value of these 50 companies has increased, reflecting positive investor sentiment. Conversely, a decline in the Nifty indicates a bearish market sentiment. Monitoring the Nifty 50 provides valuable insights into market trends and investor behavior. It allows you to gauge the performance of leading companies and identify potential investment opportunities. For instance, if the Nifty IT Index, which tracks the performance of IT companies within the Nifty 50, is outperforming the broader market, it suggests strong investor confidence in the Indian IT sector. Understanding the Nifty 50 and its sectoral indices is crucial for developing a holistic view of the Indian stock market. It lays the groundwork for more informed investment decisions, allowing you to align your portfolio with broader market trends. Let's delve deeper into Hindustan Unilever, a company that needs no introduction to Indian consumers. As a subsidiary of the global giant Unilever, Huel holds a commanding presence in the Indian fast-moving consumer goods sector, with a portfolio of over 40 brands catering to diverse needs. Hull's journey in India dates back to the 1930s, and over the decades, it has become synonymous with trust and quality. From soaps and detergents to shampoos and skincare, Hull's products are an integral part of millions of Indian households. But what makes Hull an attractive investment proposition? The answer lies in its strong fundamentals. Hull boasts a vast distribution network, reaching even the remotest corners of India. Its brand recall is unparalleled, built over decades of consistent quality and marketing prowess. Moreover, HUL has consistently demonstrated its ability to adapt to changing consumer preferences. The company has been quick to identify emerging trends, launching new products and entering new segments to stay ahead of the curve. Analyzing Hull's financials reveals a history of consistent revenue growth and profitability. Its strong balance sheet and efficient operations have made it a favorite among investors seeking stable, long-term returns. However, like any investment, HUL also faces challenges. Rising input costs, increasing competition from smaller players, and changing consumer preferences pose ongoing threats. Investors need to carefully assess these factors and monitor HUL's performance to make informed decisions. Now, let's shift our focus to Tata Consultancy Services, a company at the forefront of India's technological prowess. As one of the largest IT services and consulting companies globally, TCS partners with businesses across industries to leverage technology and drive digital transformation. From banking and financial services to healthcare and retail, TCS's expertise spans a wide range of sectors. The company's global delivery model, coupled with its vast pool of skilled engineers and consultants, has made it a trusted partner for businesses worldwide. TCS's growth story is closely intertwined with India's rise as a global IT powerhouse. The company was among the pioneers of the Indian IT outsourcing wave, establishing itself as a reliable and cost-effective alternative to global players. Over the years, TCS has evolved from a pure-play IT services provider to a strategic partner for businesses embarking on their digital transformation journeys. The company has invested heavily in emerging technologies like cloud computing, artificial intelligence, and data analytics, positioning itself at the forefront of innovation. Analyzing TCS's financials reveals a consistent track record of revenue growth and profitability. Its strong order book, reflecting a healthy pipeline of future projects, instills confidence among investors. However, TCS also faces challenges in the form of increasing competition, evolving technologies, and potential geopolitical risks. Investors need to closely monitor these factors and assess TCS's ability to adapt and innovate to maintain its leadership position. Imagine trying to predict the future movements of a river based solely on its current flow and the ripples on its surface. That's the essence of technical analysis in the stock market. Technical analysts believe that history repeats itself and that past price patterns and trading volume can provide valuable insights into future price movements. They rely on charts, indicators, and other technical tools to identify trends, support and resistance levels, and potential breakout points. One of the most basic tenets of technical analysis is the concept of trend lines. By connecting a series of higher lows on a price chart, you can draw an uptrend line, indicating that the stock is in an upward trend. Conversely, a series of lower highs forms a downtrend line, signaling a bearish trend. Another key aspect is identifying support and resistance levels. Support is a price level where a downtrend is likely to pause due to a surge in buying interest. Resistance, on the other hand, is a price level where an uptrend may encounter selling pressure. Technical analysis is not about predicting the future with absolute certainty. Instead, it's about understanding probabilities and managing risk. By identifying potential entry and exit points based on historical price patterns, technical analysts aim to increase their odds of making profitable trades. While some traders rely solely on technical analysis, it's often most effective when combined with fundamental analysis, which we'll explore in the next section.